If investors wait for all the uncertainty to resolve and for the evidence to be in, usually by that time, the opportunity is gone. The Singularity Index performed about 25% in the second quarter, which brings us to almost 4% year to date. It's both a combination of positive stock selection and sector allocation effects that led to this outperformance, about 50-50. We had very strong return contributions from names like NVIDIA, Tesla, Broadcom, Microsoft did very well, but also Shopify. In terms of absolute performance of our names, two stocks stand out in particular. That is Twilio and Datadog. They both performed more than 140% in the second quarter. Twilio is a company that develops software that weaves into companies' communication modules. So for example, the Messenger app within Uber is powered by Twilio. And Datadog is an infrastructure software company that develops monitoring and performance analysis software to help companies manage their pressure points in their key systems. The great thing is that since we've launched the fund on a 1 year forward basis, an investor in the fund has strictly done better than if he invested in broad equity markets. And actually this outperformance has increased over time. So that currently stands at about 10%. We're not trying to suggest that this outperformance is going to grow into the sky, but our aim is to consistently offer an equity proposition that will outperform over the medium to long term. So the reason why stock markets go down are not because of deteriorating economic fundamentals. The reason is really, because new information has come to light that was not priced into markets, which causes disorientation and panic, and then really is a game changer in terms of the price movement. However, information that is already on the horizon that people are discussing, for better or for worse, are not usually the big market movers. For example, after the global financial crisis in 2009, economic data continued to come back in on a very weak footing, and unemployment continued to rise, all the while equity markets rallied due to expectations of things getting better. And if investors wait for all the uncertainty to resolve and for the evidence to be in, usually by that time, the opportunity is gone. The outperformance of tech stocks has been quite significant relative to the broad market, and that begs the question whether tech stocks at this point are overvalued. To jump to the conclusion, the outperformance of tech stocks has really been driven by superior earnings. And so when you look at relative price earnings ratios of tech stocks versus the broader market, they actually don't look overvalued at all. And they are still far away from the levels that we've seen in the dot-com crisis. And I would argue we are still a long way away from a tech bubble.